Inflation affects all aspects of the economy, from consumer spending, business investment, and employment rates to government programs, tax policies, and interest rates. Understanding inflation is crucial to investing because it can reduce the value of investment returns. With inflation rising recently after several years of relative calm to its highest level in 4 decades, investors may benefit from knowing the factors driving inflation, the impact on their portfolios, and steps to consider as the investment landscape shifts. Hey there, welcome to the Daytime Dollar, where we talk about financial strategies and how small changes can make big improvements. Today, we're talking about the importance of understanding inflation and why you should invest. So let's get into it. What is inflation? Inflation is a rise in the average cost of goods and services over time. It's measured by the Bureau of Labor Statistics, which compiles data to determine the Consumer Price Index, CPI. The CPI tracks the cost of goods such as gasoline, food, clothing, and automobiles over time to gauge the overall rise in the price of consumer goods and services. Supply and demand play an important role in inflation. Prices tend to rise when demand for a good or service rises or supply for that same good or service falls. How can inflation affect investments and why you should invest in inflation? Assets with fixed, long-term cash flows tend to perform poorly when inflation is rising, since the purchasing power of those future cash flows falls over time. Conversely, commodities and assets with adjustable cash flows tend to perform better with rising inflation. Savings. Inflation can shrink your savings even if you've secured your funds in a savings account with an average interest rate. In theory, when you're working, your earnings should keep pace with inflation. When you're living off your savings, as in retirement, inflation diminishes your buying power. It's important to factor inflation into your retirement savings to ensure you have enough assets to last through your retirement years. Real assets. Real assets, such as commodities and real estate, tend to have a positive relationship with inflation, according to analysis performed by the U.S. Bank Asset Management Group. Commodities have historically been a reliable way to position for rising inflation. Inflation is measured by tracking the price of goods and services, which often contain commodities directly, as well as products closely related to commodities. Energy-related commodities like oil have a particularly strong relationship with inflation. Industrial and precious metals also tend to rise when inflation is accelerating. Property owners can often increase rent payments when prices of goods and services are rising, which can flow through to profits and investor distributions. Stock investments. According to analysis performed by the U.S. Bank Asset Management Group, stocks have held up well against inflation over the last 30 years. In theory, a company's revenues and earnings should increase at a similar pace as inflation. This means the price of your stock should rise along with the general prices of consumer and producer goods. In the past 30 years, U.S. stocks have tended to rise in price somewhat when inflation is accelerating, though the relationship is not particularly strong. Larger companies tend to have a stronger relationship with inflation than mid-sized companies, and mid-sized companies have had a stronger relationship than smaller companies. Foreign stocks in developed markets tended to fall in price when inflation was rising, and emerging market stocks displayed an even stronger negative relationship. Inflation and equities. Equities are one of the possible safe havens from rising prices, as companies' earnings should increase at a similar rate as inflation. In theory, that would drive share prices up along with the general consumer and producer goods. However, not all stocks tend to perform well during periods of high inflation. Businesses with larger market capitalization typically achieve higher returns than their smaller peers, as their market presence is more established and revenue streams are more diversified. Also, specific sectors such as commodities often experience higher returns during periods of increased inflation. On the other hand, growth stocks that expect most of their cash flows to arrive in the future, such as tech stocks, may underperform in periods of high inflation. What can you do as an investor? The best way to guard your money against inflation is to ensure that you have a solid financial roadmap, including clear goals as well as a diversified investment portfolio with some exposure to equities in place. The equities will provide an opportunity for growth, while the fixed income assets may act as a counterweight. The ratio of fixed income to equities will depend on your risk tolerance and investment objectives. A cooperator's financial representative would be happy to help you find the right balance. If you're retired and fixed income is part of your financial plan, it's especially important to talk to your advisor regularly to ensure that your investments are managing inflation. Remember, it's always a good idea to save more than you think you'll need, and to start as soon as you can, so you maximize the power of compounding growth. It's also important to reduce personal debt by as much as possible, so you can keep up with payments if interest rates rise. Cryptocurrency. Bitcoin is often described as digital gold and theoretically should protect against inflation because of limited supply. but the jury is still out on whether it will be a good inflation hedge over the long term. And as a warning to investors, R0 points to Bitcoin's recent volatility. If anything, she says it emphasizes the fact that Bitcoin can be difficult to incorporate into your diversified portfolio. Inflation refers to the general trend of an increase in prices over a certain period of time. As inflation occurs, purchasing power decreases, meaning that it costs more to buy the same good or service, or that the same amount of money buys fewer goods and services. For investors, it is important that the returns on their investments are at least the same rate as inflation. If they are less, then their investments are losing money, even if it shows gains. Similarly, individuals should ensure that their salaries increase every year at least as much as the rate of inflation, otherwise, they are technically making less money. So guys, that was all about today's topic. For more finance-related videos, please subscribe our channel. Goodbye.